I'm Chris Preston,
And I'm Brett Simmerman.
and welcome to Street Check, the best podcast in the 50 plus year history of Cabot Wealth Network. We're sort of, I'd say, the NVIDIA of Cabot Wealth podcasts, Brad. I'm just saying that so the
I,
NVIDIA
so
automatically
you,
falls.
you've been saying best podcast in the history of Cabot Wealth Network for as long as we've been doing the show. Bruce had a podcast the whole time. I mean, he never stepped up to defend himself, but
True.
there are times where I think Bruce's podcast would have probably been a better use of your time than ours.
Yeah, fair. But he's not here anymore to defend himself. So I'm just it's only gonna embolden me to say it more.
All right.
Um, okay, so busy day. We got a lot going on. Brad, tell people what we're going to talk about today.
So we are going to talk about sticky inflation and the market's response to it and the reassessment of Fed rate cuts. We're going to talk about DXYZ, a new closed-end fund called the Destiny Tech 100. That's very interesting. Then we're going to get into a little bit of an AI hype antidote. So if you find yourself getting caught up in the hype around AI, do this thing and you can avoid some of that. After that, we're going to bring Cliff on. He is going to talk about gold and metals. Gold has been melting faces this week. It's up 20% in like the last 2 months. It's definitely the best performing asset class, I think, in the last month. So excited to talk to Cliff. Before we get into that, though, as always, Chris, it is your turn to defend the hottest take you can think of. And this week, the market pullback is a good thing and should be embraced. And you have 90 seconds. You can begin now.
Okay, so pullback is sort of a strong word right now. I mean, the market is down. S&P is down slightly over 2% from its highs, and those were all-time highs. It's actually right about in line as we record, at least right about in line with its lows from a week ago. So this is it barely even qualifies as a market pullback. But if it does pull back any further, just for some perspective here, so you remember 2020, 2021, right? Like, the roaring 20s again all over for investors. It was 21 months of felt like straight up from the COVID mid-March 2020 bottom to basically the end of 2021. The S&P hit new heights, was basically felt like it was straight up. Well, there were one, two, three, four, five pullbacks of at least 3%. There are two of more than 5%. But, people barely remember those. Why? Because in the grand scheme of things, those are just normal, modest pullbacks, even 5, 6%. There was one that was almost 7%. Pullbacks are normal. They're healthy. There's usually 3 to 5 a year that are at least 3%. And we haven't had that at all during this 5+ month run. Still haven't. So if the market pulls back even another percent or two, it's not something to sweat. It just means you can buy good stocks at better prices.
Time.
So yeah, that's really all I have. Embrace it, and maybe even wait it out a little bit. If it holds support here, like I said, it's right at the as we record, at least right at the lows from a week ago. Then maybe that's an opportunity to buy back, but you might want to wait, especially with earnings season just starting. Wait to see if things pull back a little more. Good chance to get back in.
Yeah, I think Mike had a good take on it with Cabot Growth Investor this week. He is essentially saying, hey, look, we've had a lot of winners. Market's been great for the last 5 months. Hold on to those and just keep your eyes open. Maybe look for better entry prices on something that you don't
Yep.
own yet. Wait for the market to settle down. It's been weird, definitely.
Yeah.
We sort of broke our 5 month uptrend last week. NASDAQ then ripped to new highs yesterday. Um, it's not. Oh, actually, one thing I wanted to share. Insider buying at 10-year lows right now. It's like
Yeah.
half of normal insider buying levels. Michael Brush of Cabot Cannabis Investor shared internally some notes that consumer or the bull bear ratio or the consumer bullishness was at like 4.5. And pulled back to 4, which
Hmm.
normally doesn't happen. So there's some weirdness going on right now, which I think makes it pay to wait. I think
Yeah.
one kind of prescriptive quote, and I'll let you talk, is from Warren Buffett. Uh, don't buy a stock for 10 minutes unless you're thinking about owning it for 10 years. I think that's good advice right now.
Yeah.
With a weird market, you never know what's going to happen. So look for stuff that you like in the long term. But
Yeah. What was the support level in the S&P? You said S&P will pull back, and what was it? 5,000, 5,100?
that's, yeah, I mean,
Right
it's
now we're
sort
at
of
5150 as we record this.
yeah, 5,100 sort of lines up with the 50-day simple moving average. It broke below the 20-day exponential moving average, which had been the support level for the rally going back to actually November. It gapped up over that 20-day exponential moving average, and then it was pretty much perfect, picture perfect using that 20-day EMA as support, and it broke below that. So the primary trend is sort of in question. I start looking then where I would anticipate support coming in. So round numbers, 5,100 coinciding with the 50-day simple moving average is a reasonable one. Personally, I'm looking closer to like 5,000, maybe
Yeah.
4,950 because it's backfills a gap from early February. And then beyond that, you start getting into like the 4,850 level or even further. But then you're in like actual correction territory and
Yeah.
not a little bit of give back. But it's I don't know. I'm not plowing new money into things right now. But I'm bearishly biased, so
Yeah.
take that with a grain of salt.
Yeah, as you often are.
Yeah.
But yeah, I can definitely see it dipping to 5,000 or below. 5%, given 5 straight up months from what, November through March, and all the, sort of angst dating back to probably February about like, market's overcooked. We've been asking that question for weeks, maybe a couple of months. 5% pullback would seem pretty normal and warranted. Maybe we'll get to 5% or more, but yeah, I don't see a 10%, real correction coming, but we'll see. So yeah, I'd say embrace it, but maybe wait it out a little bit. I think we are going lower from here, especially now that earnings season has begun, and leads right into our first of our big three topics. Sort of mixed inflation data this week. The first one was CPI print, came in a little higher than expected. 3.5% in March was the inflation number, higher or up from higher than the 3.4% expected, and up from what, 3.2% the previous month. So people were expecting a little bit higher number, but it was a tad higher than that. It's clear that inflation is stubborn right now.
Yeah.
So it's stubborn in the 3 to 3.5% range. Then PPI, Producer Price Index, came in slightly cooler than expected yesterday. What was it?
1
2.1%?
versus 2.2
2.2
expected, I believe.
expected. And people say that's, the number that the Fed looks at more. Who knows? So sort of mixed data, which is why it's been a mixed week for stocks. What I do know is that the expectations, and we're going to take a big victory lap on this. Expectations for rate cuts this year from the Fed have been pushed back from people. Everyone thought March was when they were going to begin. You and I were very skeptical about that. Then it's pushed back to May, so it's May, June. Now, the majority expectation is that rate cuts will start in September, and that right now it's expecting 2 rate hikes, or again, rate cuts
Yeah.
this year, which is, I think, was my last defend the take, that there'll be 2 this year. I don't know. Should we just pat ourselves in the back? Like, people should tune into this podcast to get what's the real opinion, correct opinion on what the Fed's going to do. I
The
think
the
that
thing the thing that I kick myself for, I don't remember when we did this, maybe January. I gave JP Morgan a lot of credit. They came out, they were predicting what, 6 rate cuts, and I'm like, well,
crazy.
I'm not going to second guess JP Morgan. They've been getting it right for years, and maybe I should have second guessed them a little bit more. Yeah, no, I don't. There's a I'm going to be replete with sayings this week. Market can remain illogical a lot longer than you can remain solvent, or the market can remain irrational longer than you can remain solvent. Right? That's why you don't call tops. It's why I don't understand how the market is just taking at face value the anticipated 3 rate cuts or 4 rate cuts or whatever. It's doing a sort of disservice to people that are actually maybe paying attention to things that are underneath the surface. The market response to the PPI print was, I said it earlier, but weird. Nasdaq running up, probably the second. We talked about the biggest intraday reversal in 2 years last week, and this is probably the second biggest intraday reversal. It does seem like maybe there was a little bit more of that flight to growth and to tech, to like safe tech that we've been talking about, the Mag 7.
Yep.
I don't my concern now, right? Obviously I'm bearish, right? So I have to find a new thing to be worried about. I can't just celebrate the good things. The thing that I'm worried about is that a lot of the inflation in the most recent print was services driven, and we are a 70% services economy.
Yep.
So the big bugaboo then would be like a Fed pivot, right? Like people are now pricing in 2 rate cuts with a reasonable expectation that that could turn into no rate cuts. Rate hike would be the overhang, would be the thing to be really worried about. I don't necessarily see it coming, certainly not this calendar year.
No.
But if we turn into no rate cuts in September, if we keep getting hot inflation prints, maybe post-election, December, we could have the Fed coming out talking about rate hikes maybe being back on the table. I don't know. I don't have a crystal ball, but that would be what I'd be on the lookout for inflation wise. But the fact that price inflation is moderating is solid. It just is such a smaller chunk of our economy that I don't think it's going to be the driving factor for the Fed.
Yeah, I think they've gone too far down the road of, with all their cut speak. There's 0%, according to the Fed Watch tool, CME Group's Fed Watch tool, there's 0% chance of rate hikes this year. But inflation is, as they've been saying, has been stickier, more stubborn in the 3 to 3.5% range than they'd like, and I'm not surprised they're pushing back cuts to the second half of the year, possibly even to the fourth quarter. We'll see.
And I do think that headline numbers there is a risk that headline numbers come in looking worse than expected with oil prices rising. Obviously,
Yep.
when the Fed's looking at it, they're factoring out food and energy prices, but with oil back, right around $90 a barrel right now, with more potential conflict in the Middle East, there's a little bit of a sticker shock potential with oil prices being higher, at least on the headline numbers. I don't know that that's going to be driving the Fed's decision making, but something to just be aware of. You could get a market response to it.
Yeah. Okay, let's move on to our next topic. DXYZ, Destiny XYZ Inc. Is a new publicly traded fund that holds private companies. Basically, SpaceX is the biggest holding. I think you said, what is it, 45% of the portfolio?
34 point. So some
30.
stats from the portfolio: 34.6% of the portfolio is in SpaceX. 4% in Epic Games, maker of Fortnite. If you have kids or if you're a 40-year-old man, you know how much fun that is. OpenAI 3.8% of the portfolio. Stripe 2.6%, Instacart 2%, and Plaid 0.5%.
Discord is in there too.
Discord, yeah, I didn't.
Something called Superhuman. I don't know what that is.
That one I don't even know.
Yeah.
Discord, I know. Superhuman, no idea.
Yep.
So it's a closed-end fund that somebody had bought up $80 million worth of privately held shares. They rolled it into a fund. When they started filing associated documents, the market value of the assets was about $50 million. Started trading on March 26th at $9 a share.
Mm-hmm.
On April 8th, it hit $114 a share. And this $50 million market value, or notional value, closed-end fund was worth $1 billion. So that should be sort of a red flag exuberance-wise. Since then, it's down, I think, to about $40 a share was the last.
38.50 as of right now, down 23% today.
Yeah. So it's interesting. To the best of my knowledge, there are not a lot of closed-end funds out there that have pre-public offering shares in them. it's still really overvalued. Even their own literature says it's worth about 50 million bucks. So right now, people are paying a premium to get these shares that are really, really hard to get otherwise. Uh, don't buy them. Don't buy this at 30 anything a share.
Right.
That said, if this gets down to $100 million market cap, if this is trading close to like $10 a share back where it was trading when it initially came out, I think it's a good risk reward proposition there because you're buying a third of SpaceX, which is I think inarguably the most effective business that Musk is running right now.
Right now,
Uh,
yeah.
tons of contracts with the government. It's responsible for the lion's share of space flight. They rolled out sort of moonshot plans, or I guess Mars shot plans, on how they plan to use the Falcon Super Heavy to get there. Their engineering's really good. Just for that alone, I mean, with private shares, oftentimes what you're doing, or if you're venture capital, you're paying a premium for on the aggregate everything that you buy, understanding that like 3 out of 4 of the startups or 9 out of the 10 of the startups you buy are going to fail. But then the other one is going to more than make up for those failures. And that's effectively what you're doing if you're looking at something like a DXYZ, is you're paying a premium with the understanding that some of the holdings are going to absolutely fall flat, not do anything. Many of them probably will never IPO. Um, but the hope is that the other assets are going to sufficiently outperform to justify the investment. For, 34% fund share of SpaceX, I think $100 million market cap would make this a buy for me. So if it gets back down to that 9-10 range, I have no problem with it. Even with the crazy hype environment and higher interest rates and all that stuff, I still think that it looks like a good buy there. But I understand that's not really a hot take because it's going to require that the fund falls 60% from where it's trading now.
Which it might. I mean, it already was, as you said, 114 from 9 on March 26th. So what, 2 weeks ago
Yeah.
to 114. So we're seeing the evolution of the bull market and the pullback that we've just been talking about in real time. They almost top ticked the market. Um, launching. I guess they launched just before things really started to pull back, and it's sort of reflected that in the last week, basically this week, falling from 114
Yep.
to right now 30. Now we're below 38, 37 a
It's
share. So yeah, it's an interesting concept. Especially with the SpaceX exposure. We're just several intriguing privately held companies there. Um, it may get to that level that you were talking about.
yeah,
Nine.
it's somewhat thinly traded too. So structurally, there's a lot of elements to it that make it susceptible to a run up in buying like that. Thin trade, low market cap, right? It can be super volatile, but I do think it's a novel business idea, and people were excited to own SpaceX because for as much as maybe we have criticized Elon Musk, he still gets a lot of headlines.
Yeah.
So that's one that's on my radar, but I'm not buying it here.
Yeah. Yeah. Good for people to be aware of. Okay. Last, number three in our big three before we get to Cliff is AI related. It's your baby. I'll let you cook on it.
Okay, so there is a ton of AI hype right now, and it's somewhat disingenuous. So I want people to have their antenna up when it comes to all the companies that are pitching AI as the world-changing, game-changing, life-changing technology. I am bullish on AI as a technology. I think I've made that pretty clear. I mentioned a study that found that it was actually more effective. It was actually effective at managing plasma flow and fusion reactors. The current iteration of AI that everybody is hearing about is large language models, which is effectively a probabilistic prediction model. That's essentially all it does. One of the things to sort of be on the lookout is, or to be aware of, is that a lot of the news media and a lot of the investing class are referring to it as Gen AI. I think that's intentional marketing spin. When they use that to describe large language models, they mean generative AI because it produces content. But I would say Excel also produces content if you put in inputs and it gives you an output, and we're not calling Excel Gen AI. The reason I think it's spinny is because the actual thing that the actual game changer with AI is artificial general intelligence, which is a different thing, which is human level thinking on but done by a computer. So what these large language models do is they look at a big massive text, a big massive data, they recognize patterns, and then they use those patterns to then they try and recreate those patterns. So if you ask a large language model, what is a stock? It doesn't read what is a stock. It looks at each of those words as tokens, or it looks at chunks of the sentence as tokens. Then it looks at its training model or its training data, and based on the patterns that appear in the training data, it tries to replicate those, which is why if you ask OpenAI, ChatGPT, or if you ask Microsoft's Copilot, what's a stock, they spit out a pretty good explanation of what a stock is. The thing to remember is the AI does not understand what that means. What it is a predictive output based on a probabilistic model. So the next time you find yourself getting hyped up for AI, I want you to do me a favor if you have an iPhone. Chris, I would like you to do this now as well. So
Yeah.
take out your phone and open a text message to somebody.
Yeah.
Okay. Then when you go to start the text message, below that there should be three choices. This is their predictive text. Do you have that? If your predictive text is off, it's fine. I can do it on my own.
Yeah,
So like
you talking opening a new message?
yeah, like you're going to type a message to bring up your keyboard. Above the letters, do you have three words?
No.
Okay.
It
All
says
right.
new message and cancel.
Okay. So I'll set this, I'll do this on my end. iOS has a predictive text, which does roughly the same thing as a large language model does. It's just really, really dumb and has a really small training set. And what it does is it allows you to type in a word and then it predicts the next word in the sequence,
Yeah.
which is the same thing the large language models do. What I'm doing is I'm just hitting their predictive text like 15 times. The sentence that it told me I'm trying to type right now without giving it any input is the only way I could be a better player than you are right here. Right here is this picture of me is to play the guitar in your ear. It doesn't know what I'm typing. What it is doing is it is taking the available inputs and it is making a probabilistic prediction of what comes next. That is what the current iteration of large language models do. They do it in a much better way. They're very sophisticated pattern recognition software, but they don't know what they're doing. So you need to take a heavy, heavy dose of skepticism to anything that you see about game-changing AI. There are legit concerns that there may not be enough training data on the internet to support the next iteration of ChatGPT, which would be ChatGPT 5. There are studies indicating that, or I believe it was a study that indicated they'd used about 10% of the internet for their training data for GPT-4. That is all that they could find that was high quality enough to use as training data. They'll need at least 5 times that much, is what I've read for the next iteration. So be very skeptical when these AI companies come out and tell you that they're changing the game. Right now, they have probabilistic models that are only giving you outputs based on all this other content they've read. They're not creating anything new. If we get to artificial general intelligence where machines think like people, absolute game changer, world changer. This is not that. So take that dose of skepticism with you as we navigate what is now sort of a pullback, questionable market, and as the Nasdaq rips to new highs.
That may all your skepticism. I share your skepticism about AI in general, but AI as an investment, yes, it is pulling back as we thought it might right now, but I still think it's in general a good investment over the intermediate to long term. I do think just like people have been skeptical about Tesla during its entire run. And obviously recently it's had some stumbles, but I've had friends here who, 5 years ago were saying, I'll never invest in Tesla because X. And meanwhile, they've missed out on, we've had it in the stock of the week portfolio since December 2011, and it's up 9,000%. I don't know if there's any AI play that'll be up that much, but I don't think you can. just take AI out of your portfolio because of these growing pains. You know what I mean?
No, I don't think you can take it out of your. I mean, if you own the S&P 500, you can't take it out of your portfolio
Right.
because AI plays are like a third of the S&P right now. So we all have some exposure to AI, and there will be winners and losers. Amazon, if you bought Amazon before the market crash in the 2001, you made a fortune. You did a great job. Uh, where it's problematic is when companies lean into the narrative without actually doing anything with it or without actually delivering returns for investors or for their company. Um, that's we're sort of in that bubble territory right now. Nvidia is trading at a higher price to sales ratio than Cisco did before the dot-com crash. So this stuff is somewhat overvalued, and maybe Nvidia goes on to be worth like split adjusted 10,000 a share 10 years from now. Maybe. I don't know. I don't have I was going to say silver ball, crystal ball.
Yeah.
But be on the lookout. Make sure that you're not buying into AI names simply because of the hype. Look for actual business results. I think that those are, as we get through into and through earnings season, I think those are going to be harder to come by than a lot of people are expecting.
Okay, let's get to Clif Droke, who is our resident gold and metals expert. We'll get to him after this quick break. All right, we welcome on Clif Droke, who is a market veteran, longtime gold and metals expert, who is a contributor to our Cabot Top 10 Trader momentum investing service, which right now is there's nothing that has more momentum right now than gold, silver, metals. Gold is now above 2,400 an ounce, all-time highs. I mean, it was all-time highs when it hit 2,300 earlier this week. Silver prices up more than 25% since just the beginning of March. Copper is at, I believe, 22-month highs. What is happening? Why are metals on a tear right now?
Well, it's speculative, of course. Everyone seems to have a different opinion. Gold often has a mind of its own. It can be dollar independent. Right now the U.S. dollar index is strengthening a bit, so you can't blame it as necessarily a dollar weakness trade. But what seems to be happening is just inflation. There's more. It's stickier than the market is anticipated. There is a component to the consumer price index called the sticky CPI, which takes a look at things that prices like automobile repairs and housing and so forth that tend to, the inflation just isn't coming down in those areas, and consumers are getting worried, and so they turn to gold. Investors and consumers turn to gold when there's worries about inflation, and that seems to be the driving factor right now.
Yeah, and what's unique about this rally, and we mentioned this last week. There's an analyst, I can't remember if it was with JP Morgan or Goldman Sachs. Anyway, we mentioned it last week, calling this sort of the everything rally, where gold stocks, at least as of a week ago, not so much now, gold stocks, Bitcoin, all at all-time highs simultaneously. That's not something you see very often, right? Usually the flight to gold is a safety thing when stocks are plummeting, right?
That's true. The interesting thing about gold is it tends to outperform at both ends of the long-term economic spectrum. That is, extreme deflationary pressures and extreme inflationary pressures. Right now, we're on the extreme inflation side, so we're seeing the outperformance there. And you mentioned the everything rally. My understanding of inflation is part and parcel of it is tends to be accompanied by a fair amount of liquidity in the financial markets, and I think that would account for Bitcoin and stocks. There's obviously a lot of liquidity out there, but for gold, it's not so much a liquidity play as I think it is a defensive play, a hedging play among these mainly, actually, up until very recently, institutional players, central banks, big boys have been doing most of the buying, and they have their reasons. Um, and from an investor sentiment standpoint, the fact that smaller investors haven't been jumping in until just recently, I think bodes well, from a contrarian perspective for gold.
Now, Cliff, one of the big criticisms for gold as a long-term holding is that it doesn't offer a yield, right? Like if in a flight to safety environment, Your two options are gold or treasuries, right? Depending on how you feel about fiat currency in general. Um, but treasuries have the upside of offering a yield. Do you have a stance on using things like options trades to create like a synthetic yield in gold? Is that something that you've used in your own portfolio or that you've recommended? Do you have any maybe warnings against that? Because that strikes me as maybe a good way to mitigate some of the no yield risk of holding gold for an intermediate or longer term.
Traders that are more aggressive and have a higher risk tolerance can certainly can utilize options. I don't, because financially I'm a conservative, and I believe that using any form of debt kind of undermines the whole purpose of using gold, which is to hedge against potential debt, the shortfalls of debt, like we saw in 2008, of course. So I personally don't use options when I'm talking about gold. I believe gold is not so much a speculative medium anyway. It's something that I think all investors should have a small percentage of their portfolio in, just as an anchor, as a hedge. And I don't think yield should enter into the equation if you're using gold in what I regard as the proper manner, as strictly a hedge.
Yeah, perfect. I mean, that's a perfect response, right? Like hedging it in because it's already a hedge, hedging your hedge intuitively undercuts the value of it as a position. So thank you. Asked and answered.
Yeah. Right. Yeah. Good response. Okay. So as I mentioned, it's not just gold right now. Silver is up like 25% since the start of March. Copper is up to almost 2-year highs. Is that just sort of an in tandem with gold kind of a thing? Is this, at least with silver, I know this is what we often see. They sort of go hand in hand. Is it the same with copper too, usually?
Not usually. In a broad metal space rally like we're starting to see now, that is normal.
Yeah.
There is something that investors will probably be familiar with. It's called the copper gold ratio, and it compares copper's performance to gold. And the implication behind it is that when, copper being really an economic metal, when copper is doing well, it bodes well typically for the global economy. When copper is not doing well, gold can often outperform because it implies global economic weakness, and people are going to be naturally gravitating to gold as a hedge. That has been one of the reasons lately. Copper has drastically underperformed gold. It continues to do so, actually, and you could almost use that as an argument for gold, that investors are perhaps worried about a global slowdown, possibly in the coming year. So I wouldn't throw copper in the category as being a speculative play. Silver has the industrial factor going for it. Industrial demand for silver is heating up to highs we haven't seen in over 10 years. A lot of it has to do with the green revolution, the alternate energy revolution. So it's got its own unique demand factors in play.
What are you seeing with battery metals lately? I know that's something that you've written about in the past. I'm curious. I don't know. I haven't looked at the battery metals, but things like lithium, how are they performing of late?
Well, they've been in the dumps, to be quite brutally honest. They have underperformed. I, as someone who's not that much of an expert in the alternate energy transition, I won't offer an opinion as to why that is. Obviously, a lot of it is tied to EV demand.
Yeah,
and that's been down. We've talked about that recently. The EV demand being down and stocks being down, as like people pivot to hybrids is sort of an alternative. But yeah, sorry, go ahead.
It does seem.
Oh, go ahead, Brett.
I was just going to say, it does seem consistent with lower demand for copper as well, right? Because the underlying demand pressures for copper and battery metals are both going to be new technology adoption and very specific sort of directional economic growth. So that battery metals are in the dumps, I think was the way that you'd phrased it. And that copper is relatively underperforming does, I think, make a strong case that the gold play right now and the silver play is a defensive play more than a growth play. Well, for silver specifically.
That exactly. That said, I'm starting to see just superficially some evidence that the base metals are likely basing. We're probably going to see at some point in the coming months an upturn. It's really the battery metals are turning into a value play at this point. And they look interesting. I'll say that.
But would it be in falling knife territory right now for battery metals if you were looking at making a play on them?
I would say we're probably past the falling knife stage. I wouldn't go in with both hands, but I personally am doing a little nibbling for the first time in quite a while. So I'm seeing a little something to be attracted to right now. Mainly in lithium.
Okay, yeah, I was going to ask which, lithium. So I get you talked about the inflation being inflation stickiness being maybe the biggest reason, probably the biggest reason that gold is up. There's been some talk about, geopolitical risks, especially now. I guess Iran is set to get involved in the, invade Gaza soon. Whether that happens, who knows? But that the fears of that are seemingly playing a part. Do you think, how much of a factor do you think that is in gold, silver spiking to new highs?
It's a factor. It's one of the factors. I think an even bigger factor in the immediate term is there's been a record amount of central bank buying, the highest level since 1967. In fact, a lot of it is just big institutions, sovereign wealth funds, central banks are just buying. Russia has recently announced they're doubling their buying of gold. There's just all this massive demand for it worldwide. And how much of that is geopolitical, I don't know, but that would certainly be a factor. Obviously, the fear factor is always a big part of gold demand.
I thought I saw a headline, and I can't back this up, but did Zimbabwe just launch a gold-backed currency? Am
I believe so. That headline crossed me some time ago. I'm not up to date on it, but Russia is trying to do the same. In fact, the BRICS countries in the aggregate are moving in that direction, launching gold-backed currency. Everybody seems to want to replace the dollar, and whether that happens or not is conjectural. But a lot of countries are trying to diversify, and they're using gold as a backbone in their attempts at getting away.
Yeah, I think you can sort of make two. You can use two justifications. One being that we are printing money like crazy, and our debt is spiking, and the other is obviously more oppositional, where it's the geopolitical order questions and whether you want to be associated, whether you want to be tethered to the dollar if you're militarily or politically oppositional. So I don't know which one is better. I think those are both sort of scary thoughts to me, but certainly a case for gold.
Absolutely. Gold, I've never seen as many cases for gold fundamentally and technically and psychologically in quite some time. So it's definitely the place to be right now.
Yeah, that's why you've got a smile on your face this whole time. Yeah. So what are some ways that you would play, I guess, just gold and silver, putting aside, battery metals, lithium is a value play. Gold and silver, what are some recommendations you have on ways to play it, whether those are ETFs or particular stocks? So what do you like right now?
Well, when it comes to gold and silver, I'm the ultimate KISS guy. Keep it short and simple, nothing fancy. I like just basic gold and silver ETFs. I'll throw out a couple of symbols: SLV for silver, BAR or IAU for gold. Just having some basic ETF exposure is a very simple way to do it, low cost way to do it. I wouldn't necessarily, I mean, unless you're long-term oriented, I wouldn't advocate buying a bunch of physical gold and silver. But for me, it's always been the ETFs.
Yeah, and I know that you, we mentioned you contributed to a Cabot Top 10 Trader. I know that you've written up some gold and silver stocks recently, which we won't give away here, but if people are looking for those recommendations, I highly recommend subscribing to Cabot Top 10 Trader. You can find it on the cabotwealth.com website. Brad, any other questions for Cliff? Well,
this one may be a little bit more in jest. Costco selling 200 million of gold a month, it appears to be, to its subscribers, its members. I know you just said that you're not a big physical guy. Bad idea to just throw one in the cart on your next Costco run, because it strikes me as maybe a reasonable way to do it if you're looking to pick up $2,000 or $2,400 worth of gold these days.
I'm not averse to it. I certainly am not trying to dissuade anyone from owning physical gold. It's not a bad idea. Um,
You have to keep it safe, and then liquidation is more of a pain.
it really is. It really is. Unless you've got a coin store in your neighborhood, which makes it easy. It's not the easiest thing to store, and there's always the worry of, you could lose it. So got to be careful.
Yeah, stocks ETFs seem like a bit safer way to play that. Yeah, and it's not just top 10 trader that we've had gold and silver recommendations lately. I know across several of our advisors, Cabot Explorer, run by Carl Delfeld, it's a global investing portfolio. I know he just added a gold and silver play. I've got one in Cabot Value Investor. That was fairly recent addition, I think in the last month. So yeah, I mean, this is as mainstream as it's been. I guess that reflects, Cliff, what you were saying. This is as mainstream as a gold and silver rally has been in a long time.
Exactly. It's turning into something you rarely see. It's a momentum play. I mean, how often do you see gold? It's been, I almost want to say decades since I've seen quite this much strength. But it certainly bodes well for the longer term. I would hasten to add, gold is broken out from a 4-year. This is strictly from a technical perspective, a 4-year basing pattern. And if you're a chart guy, it argues it's got some upside ahead of it.
And what do you think I mentioned the everything rally, stocks, Bitcoin too, and gold all being at or near all-time highs. Do you think something has to give where one of them, I guess would it help gold for stocks to pull back, or do you think the momentum is so strong right now it doesn't really matter?
It doesn't. I would say it doesn't matter. It reminds me of heading into the credit crisis, the 2007, 2008, when gold, for a while there, gold and other commodities and stocks were all going in the same direction, and gold ultimately prevailed. Gold did go down with stocks that in 2008, but it was the first to bounce back and had a huge rebound into 2009. This is the type of environment we've seen in the past where when gold starts to outperform like this, it typically keeps it up for a while, and it can be irregardless of what's happening in other risk assets.
Well, I hope that the gold rally this time doesn't portend similar ominous crash that 0708 did. Sorry, Brad, you had one more thing.
Yeah, if stocks break, I'd rather be in gold than crypto. I mean, or if crypto breaks, I'd rather be in gold than stocks. I mean, like if one of those three breaks down, I think gold is probably the same. This is coming from a guy that is not a gold bug. I'm not a huge gold guy, but if we're seeing a breakdown in any of those three asset classes, given the choice of the three, I think there's a case for gold stronger than any others.
I agree. I'm not a crypto guy, but my understanding is crypto is more reflective of risk. Traders embracing risk that more than anything, and a lot of people want to equate it to the new safe haven. I don't see crypto as a safe haven.
No, purely a bull market play. It seems.
I agree.
Stocks hit all-time highs and were up 5 straight months. Bitcoin hit all-time highs and been up the whole time, but that seems to be wobbling a little bit. And as we mentioned, the only utility that crypto has is as a bull market play, really, whereas gold and silver obviously have many utilities.
And Cliff made a half joke in response to the fact that you could, buying gold is a good idea. Well, you can lose it. Yeah, crypto, if you lose a seed phrase, if you lose your crypto wallet, you can lose that too. And it's a lot easier to lose a USB drive that you use to secure your crypto assets than it is to lose, say, a pound of gold or 10 ounces of gold. So
that's a good point.
The risks that you have, and it doesn't yield anything either. So the risks that you have with gold are amplified with crypto.
I agree. That's another reason. And yeah, things are looking good. I mean, I don't want to sound. I hope I'm not top taking the market. It's sounding, but
I have
don't
bad
think
news.
so.
Given the podcast that you're on, you very well might be.
Yeah. Seems like anytime we have Mike on, which we did 2 weeks ago, that was sort of top ticking growth stocks, and then Michael Brush we've had on to talk about cannabis every time. It seems like it goes back down. But so hopefully that you won't suffer a similar fate. But we had to have you on it.
Yeah, absolutely.
Golden metals have not been, like you said, this hot in maybe a decade and a half. So Clif, thanks for joining us again. You can read him at Cabot Top 10 Trader, where he's a contributor, and their gold medals.
And the Cabot Wealth Daily, where he's a contributor.
Yeah, sorry.
Thank you.
Cabot Wealth Daily. Yeah, on the Cabot Wealth. It's all on the cabotwealth.com site. And Clif, thanks for joining us. And thanks everyone for joining Street Check this week. And we will be back next week with our next episode. As always, like and subscribe.